Sanjeev Prasad joining us this morning to discuss some of the ongoing factors at play and the strategy going forward. Sanjeev, good to have you with us. We were going through a few different reports this morning and expectations that perhaps, the second wave, as long as we do see that peak coming in soon, will have a more limited economic impact than we saw last year. That's the hope or speculation at this point. Anyway, I want to get your perspective into really how you're factoring some of this in, given there's so much uncertainty at the moment.
Well, I would agree to that view. It looks like, the number of new cases could peak over the next 2-3 weeks. And whatever measures the state governments have implemented in the form of partial lockdown, that seems to be working. We've already seen numbers in Maharashtra, for example, which went into lockdown earlier compared to other states. The daily new confirmed cases numbers are plateauing. And in the worst affected districts of Maharashtra, such as Mumbai, Thane, we are starting to see a decline actually in the number of new cases. So all that bodes well. That's hopefully a precursor to what could take place in other states over the next 2-3 weeks, which went into lockdown after Maharashtra. And you're already seeing in some states the number of new cases starting to plateau, and in some cases also starting to come off. And the other positive point, I use this term in a very relative sense over here, is that if you look at the number of daily new or rather daily recovered cases and compare that data with the number of new cases, that is confirmed cases 10, 12, 14 days back, those numbers are now more or less similar. So what that means is people who got infected with the virus, tested positive 10, 12, 14 days back, most people seem to be recovering now. So that's again a relatively positive sign, I would say.
Okay, I notice a lot of defensives in the May portfolio, Sanjeev. Is that really the kind of view at the moment? Would you still be looking at cyclicals from a slightly more longer term perspective, but as a good entry point currently on dips, or would you stick with the defensives for the moment? I do notice that in May at least the portfolio comprises of a good mix of those.
You see, we have a mix anyway, and we look at stocks more on a bottom-up basis. So wherever we think there is value, it doesn't really matter whether it's a growth stock, value stock, cyclical stock, call it by whatever label. We are okay with it. But if you were, let's say, in a hypothetical portfolio, if the position was more toward defensives, maybe one can take the call of moving towards cyclicals. And by cyclicals, I mean essentially domestic cyclicals such as financials, capital goods, real estate, etc. And if you're already overweight, I guess, on the cyclical part, that is, I guess you'll stay overweight, looking at the fact that incremental news flow over the next 2-3 weeks, could get better, again, relatively speaking, compared to the very grim news that we are seeing currently in terms of daily new cases. And unfortunately, that's also in several cases.
So how does it really spell for the market sentiment? Because even in a market like yesterday, for instance, where you had a big, daily toll across the country, there are already news reports that the virus is now spreading to tier 2, 3 and some of the tier 4 cities as well, much unlike the first wave back in 2020, about a year back. You had the state election verdict as well. Even then, the market showed you a very, very strong rebound after a gap-up start. And we're practically sitting at those same levels right now and building on to them further. Would you say that it would have to be a global news flow or a global data point for the market to see correction from here? And while the upside may be capped, the downside also would be, just looking at the domestic parameters and data points?
See, the markets are always very clinical, and in a way you could also say cynical. In the sense that, yes, there is a lot of, bad news, which is very negative from an emotional perspective, but markets are really, unfortunately, unemotional. And if you look at the impact on cash flows of companies, even if you have, let's say, a number of states in lockdown over the next few weeks, how much does it really impact the fair value of a company? If you assume that the impact of lockdowns will be somewhat limited, and this time around we have had, somewhat more diluted form of lockdowns, maybe use it of partial lockdowns. It doesn't really impact the fair value of a company. And even if they have, 1 or 2 quarters of lower earnings or cash flows, it doesn't really change the fair value of a company that much if you look in the context of, discounted cash flows in perpetuity. So that's how markets are looking at this situation, even though the human toll and tragedy is pretty grim. Markets are just looking through it and, taking a call that the economic impact is limited, impact on earnings cash flow is limited, so the fair value of individual stocks and thereby the market shouldn't change that much. So what could change is, if anything changes with respect to the expectation on the other side of the equation, which is on cost of equity. So globally, we saw one in the round of increase in bond yields. After that, bond yields are more or less stable. And in the US, we have a very fantastic situation where markets are factoring in a very strong recovery from an economic standpoint, and obviously that is good news for earnings. But also at the same point, not really factoring in any increase in bond yields. In the sense, there is a faith in the central bank, which is the US Fed in this case, to manage bond yields. We have the best of fiscal policy and monetary policy at the same time, and a super strong economic recovery, and that is what is the key peg for global sentiment. Same thing as situation in Europe. Europe has finally got through its vaccination challenges. Now you are seeing a big increase in vaccination rollout. EU average has reached about 33%, and the number will only increase going forward. And again, EU will also be on the recovery path, which the US already is on over the next few months, and clearly, there is very little chance of a big increase in bond yields or any change in the monetary policy of the ECB, at least in the foreseeable future. Now you come to India, I guess we are also in a similar situation. The market still has confidence in the RBI's ability to manage bond yields, but if you see any change over there, and obviously the bond markets will keep testing the RBI's resolve over here, because you clearly have a big supply-demand mismatch between supply of bonds and demand for bonds. And this second wave will definitely impact government finances also. So that may put some upward pressure on bond yields in India, and maybe act as some sort of a headwind for the market. But as long as the earnings story is broadly intact, I'm not very sure what will bring down this market, despite all the grim headline news one is reading. I'm not sure whether that really translates into a lot of earning downgrades as yet, and a big increase in cost of equity or government bond yields at the same time.
Sure. So, Sanjeev, is it going to be more of the same, IT, pharma, metals, that's going to find favor and that's going to hold in this market?
Yeah, for the time being, I guess, that's where I guess the positive news, and definitely in the case of metals, IT, pharma, people are more looking at, I guess, some form of defensive compared to consumer staples. Having said that, you have seen some disappointment in the IT numbers in the fourth quarter of FY21, and some stocks have come off pretty sharply, actually. Look at CLTech, Tech Mahindra, etc. They have disappointed, and pharma is actually the one which is doing a lot better this time around. I guess the big debate as of now is, whether people want to get overweight on the financial names, and some people are already positioned that way. Some people are looking at, this as some sort of opportunity if you see a deeper correction in the financials due to worries about collections, increase in, credit costs, and so on and so forth. And look at, adding to financials as a post second wave economic recovery play.
Sanjeev, hi there. Good morning. With a lot of corporates that we interact with, while they do acknowledge the impact of the second wave, there was that there was an acknowledgement that the rural theme was still holding out and doing quite well. Would you, within the auto space and other sectors as well, based on the rural story going strong?
See, rural, you have to differentiate between agri and non-agri. Agri part of rural India is doing fine, or at least did well over the last 12 months based on, very high food prices. Now, we'll have to wait and see, what happens to monsoon food prices this year. All indications are that this year also should be normal monsoon and, reason that will support farm incomes. But the non-agri part of rural India is not doing very well, and we are seeing a fair amount of negative impact on household incomes. Also, keep in mind the fact that rural incomes are also supported by incomes which are earned in urban areas. You have repatriation of incomes from cities to villages, and if people in urban areas who are typically migrants from rural India, if their job prospects suffer, which unfortunately will be the case if you have lockdowns and part lockdowns in many states, that would also impact rural India. So I don't think you can just use one broad brush to look at rural India. Also, as far as auto is concerned, there are different dynamics for the four sub segments of auto. And two-wheelers, we don't really like it too much. Penetration is already quite high in India, 60% household. Growth will slow down in the next few years, and you have the threat of EVs also coming, and some companies are really not positioned in the EV space that well. Four-wheeler valuation is expensive. Clearly, there will be some impact on demand this year too. CV cycle is doing fine, but again, valuation is a challenge over there. Tractor should be okay, I guess, this year too. So you have to look at every sub-segment fairly carefully because the dynamics are very different in each sector.
Okay, Sanjeev, curious as to how you're looking at the entire telecom story, because when Jio came onto the scene, one thought that they were going to be completely unstoppable, and we have seen now that things have changed to a greater extent, and that it is a strong 2.5, as Sunil Bharti Mittal described it, race within the within the telecom space. How are you looking at how things have panned out, the overall subscriber addition, telecom penetration in the country, and the three listed players?
Well, the penetration story is largely done. Now the story has shifted to the ARPU increase story, which unfortunately is not really playing out, even with the 2.5 player market, as you put it. It doesn't look like this industry has any pricing power. And of course, you won't have pricing power till the time Reliance takes a call to increase prices, and Reliance possibly sees no necessity to raise prices for the time being. It's in a very strong position as far as balance sheet is concerned. Raised a lot of money last year, so no real urgency for Reliance Jio to raise prices. So I guess we'll figure out over the next 1-2 years as to how Vodafone Idea situation changes. If there is no ARPU increase, clearly things will become worse because you will have incremental payouts of both AGR and spectrum liabilities coming up, which may be a bit of a challenge for Vodafone Idea under the current circumstances. So ARPU increases is imperative for Vodafone Idea. I guess not so much for Reliance and Bharti. So you have this very, obviously peculiar kind of a market where people are, all hoping for ARPU increases. But for the last 1 year, we haven't really seen any improvement as far as ARPUs are concerned.
Sanjeev, your view on gold. I wanna get a sense from you on where that's headed, and I also see investments on the back of that, on the back of the outlook that you have on the commodity and the precious metal. Tell us.
Well, just repeat that. I lost the question a little bit.
No worries, no worries. Your view on gold I wanted to get because I can
Gold.
see that you're looking quite confident both on the metal as well as investments like Titan, etc. Yeah, yeah.
Look, I'm no expert on gold, and gold, ultimately works well when you have very bad news. In the sense, you have deflation-like scenario. You need, protect your assets to whatever extent you can when things are very, very bad. I don't think we are in that kind of a situation as far as financial or the economy is concerned. Or gold works very well when you have very high inflation. Again, you need to protect the value of assets. We move to I guess gold, which has, as a store of value. Otherwise, in this kind of a market where you have, or this kind of an economy, I'm really not sure what is the role of gold, especially if, over the next 1-2 years, you also start seeing, global interest rates starting to move up, as and when they do. Again, the utility of gold goes down, right? Unless until you get into very high inflation, there is really no point of owning gold. So gold, my view always has been, you own some for a rainy day, 5-10% of your overall net worth as portfolio, whatever you want to keep in that. And the rest you allocate to other assets depending on your risk profile. I mean, gold doesn't earn any cash flows or any gives you any dividends, right? So it's not a very easy thing to value. It more depends on, what is happening in the rest of the economy, which in turn will people take a call on relative value of gold vis-a-vis other asset classes.
Okay, sure. Sanjeev, how much of a portfolio do you feel one should be looking at outside of Indian equities right now? I mean, when you're talking about perhaps alternative assets, but outside of that, even US equities with so much action and definitely a little bit more of a resurgence there at the moment. Retail investors here, is that something they're even considering, or would you, would you remain fairly India focused given the kind of domestic growth story that everyone's still looking at down the line?
It's a tricky question for me to answer, honestly. But it depends on everybody's or individual risk profile. If you think you can get better growth prospects investing somewhere else, one is free to take that call. But having said that, how many people in India really have that opportunity? Most people will have to be invested in Indian assets only. If you want some risk diversification, whatever reasons, maybe you can take that call. But otherwise, most assets will remain in India as far as most households are concerned, right? You have a lot of restriction on how much money you can invest. And anyway, that is only applicable more for very rich households.
Thank you so much, Sanjeev, for taking time out and joining in.